If you are investing your money in 2026, you need to watch this video because the stock market is at record highs. The housing market is near record highs. Gold prices are at record highs and silver prices are at record highs. And there are only three options that can happen in 2026. There are no other options. Option number one is asset prices go higher. Option number two is asset prices go lower. Option number three is asset prices stay the same. And everybody is trying to predict what is going to happen in 2026, and then they're investing their money based off of what they think is going to happen in 2026. And I have news for you. Nobody knows. Not a random guy on YouTube, not Warren Buffett, not the White House, not anybody. Everybody has predictions, everybody has ideas, but if you are investing your money, you should not be investing your money based off of what you think is going to happen in 2026 because nobody knows. But what we do know by studying history is that if we can now zoom out a little bit and look at the markets for 10 years, 20 years, 30 years, now you can start to see a pattern. Markets go like this. They are volatile in the short term. They can boom and crash in the short term, but over the long run, we have seen markets go up. And this is the mistake that so many people are going to make because there's a lot of changes happening in 2026. The Federal Reserve Bank started printing more money. Again, they ended quantitative tightening in the end of 2025, which essentially means they're going to be printing more money in 2026. That is official. This is not a conspiracy. This has been now publicized and documented. Number two, President Trump is making a lot of economic policy changes. He's made a lot of changes in 2025 that are going to accelerate in 2026 because we are seeing an economic fight between the United States and China. China has begun restricting, starting on January 1st, exports of specific metals to the United States that we need for our economy. And in response, the Trump administration is now working to change our supply chain, to change our policies here in the United States, that way we can produce more of that stuff. We're going to see a new head of the Federal Reserve Bank in May of 2026 because Jerome Powell, who is the current head, is going to retire and he's going to be replaced by somebody else. We're going to see AI explode even more in 2026. All these things are going to impact the economy in many ways. Some are going to impact it in a good way for the stock market. Some are going to be bad for the stock market. Some are going to be good for jobs. Some are going to be bad for jobs. Some are going to be good for inflation. Some are going to be bad for inflation. But what we know is it's going to create volatility. Markets are going to go up. They're going to go down. And we have so many people now betting money that maybe they shouldn't be, hoping that they're going to see a specific result in 2026. And I want you to understand, my job here is to help you be a smarter investor. And if you want to be a smarter investor, you have to understand the basics of what it means to invest. And investing does not mean investing for 2 months or 6 months or even 12 months. It's investing for the long term. We're going to see a lot of changes. When I talk about what the Federal Reserve Bank is doing, it's going to make a short-term impact. But the real value, the real wealth is understanding the long-term impacts because that's where you're going to see the biggest growth of your money. When I talk about how tariffs are going to impact the supply chain of specific industries, it's going to have a short-term impact. It can cause certain stocks to go down, it can cause certain stocks to go up, but the real value is understanding how it's going to change our economy and how it's going to change investment opportunities for the long run. Again, this is why I've talked about this a few times now. On January 13th, I'm hosting a live investor workshop because we had the biggest economic changes that we've seen in many, many years in 2025, and they're going to accelerate in 2026. And the people that understand this are going to be able to set up their investments. They're going to be able to set up their portfolios to build more wealth. And so on this workshop, I want to go over not just how the economy is shifting, but how these shifts create investment opportunities. I have a bunch of research that my team and my firm has put together that I'm going to be presenting on January 13th. I'm doing it live twice on January 13th, once in the morning at 10:30 a.m. Eastern Time, and then again in the evening at 8 p.m. Eastern Time. If you'd like to join me, you do have to register. I have the link for you down in the description below. And when you register, I do want to remind you that if you are interested, please register soon because our software has a limited number of people that can actually join me live. So if you're interested, register soon. I'll be going over all the shifts that are happening on January 13th. But this is where I have to caution you, not just that, hey, asset prices don't always go up because they go up and down, but I want you to understand that there's no way to predict what's going to happen tomorrow. There's a saying on Wall Street that goes, bulls make money, bears make money, pigs get slaughtered. The people that think markets are going to go up can make a lot of money. The people that think markets are going to go down can make a lot of money. The people that lose money are the people that get greedy. It's the pigs. And unfortunately, there are a few rules, basic rules of investing that a lot of people forget, especially when you see such growth in markets. I mean, we saw the stock market grow by 16% in 2025. We saw gold prices boom by 50, 60% in 2025. We saw silver prices grow by 165% in 2025. And when you start to see these types of price growths, and then you keep hearing about people saying 2026 is going to be even better, we start to forget what is reality. Because over the last 100 years, markets have grown by 10% a year on average. What does that mean? It means some years the markets grow faster than 10%. Some years markets grow less than 10%. Some years markets shrink. Now, which one is going to happen in 2026? Nobody knows. We know that there's going to be a lot of economic changes that are going to be beneficial for investors in the long run. Could we see a recession or a market crash happen before that? Maybe. Nobody knows. We know that recessions happen. We know that market crashes happen. And so if you're going to be an investor, remember, there are a few basic rules. Number one, investing is a long-term game. It is a marathon, not a sprint. Investing is about thinking about years, not days. Number two, do not invest more than you are willing to lose. One of the weirdest and strangest comments I get is when people talk about, I'm investing my money, and I really hope that I'm going to make money because I got to be able to pay these bills by Friday. That's not investing. That's trading. That's gambling. It's a completely different game. That's not what investing is about. Investing is taking your extra money, putting it to work, and letting it sit there and grow, and not needing that money, because when you need that money, you're going to make emotional decisions that are going to probably cost you a lot more money than you think. Number three, don't invest in things that you do not understand. And this is really a concept that we get taught time and time again, because people want to buy what they think is going to make them money. And when you buy what you think is going to make you money, as opposed to buying an investment, as opposed to buying an asset that you believe has value, you now get into a very dangerous space of trying to chase momentum and trying to chase hype. And one of the things that has been very successful for my research firm, Market Briefs Pro, is we've been able to now identify the difference between hype and research. And what a lot of people are doing is they look at momentum. What is being talked about on Reddit? What's being talked about on CNBC? What are people betting on? And let me buy that thing because the stock has already gone up so much. This thing has already gone up so much. This crypto, whatever. So I want to jump into that because people have made a lot of money. But by the time it's on the news, a lot of the real money has already been made. And this is where I caution people to stop trying to chase the next Bitcoin, the next Nvidia, the next hot thing, and instead try to just be an investor. Because when you try to chase the 200% returns a year, a lot of times you don't get anywhere close to that. You might get a couple big wins, but now you get into that gambling game. And think about one of the wealthiest people in the world, one of the wealthiest investors in the world, Warren Buffett, who just retired. Over his many decades of career, which he built his wealth by being an investor. That's his wealth. He slowly compounded his wealth year after year, decade after decade, decade after decade. He didn't average 100% returns a year. He didn't average 50% returns a year. He didn't even average 30% returns a year. He averaged about 20% returns a year. And we're talking about one of the best investors in the world. And so now when people come up with these ideas of how you can get 50 to 100% returns a year with these hot movements, you have to be a little bit cautious. And this is why one of the things that I talk about is if you're going to be an active investor, where you're going to be investing into where money is moving, you're going to be investing in individual companies, great. But you don't need to shoot for 50%, 20%, or even 15% returns. Just slightly better returns than the market can add up to significant more wealth over the long term. Now, if you can get closer to Warren Buffett returns, great. But statistically, most people are not going to. And so anytime you try to shoot for something bigger, you have the potential to make a whole lot of money, but your chances of making that money start to go down. And if you are going to invest your money, you have to understand that there is risk involved. Markets go up, markets go down. And I have been making videos on YouTube for about a decade now. And the thing that I have learned is we trade and make decisions based off of emotion as opposed to logic. And it's become more amplified because of the internet. I first started investing after the 2008 crash. And it wasn't because I was a genius investor. It was just because that was the time that I started investing. I got very lucky that I started investing when markets were at an all-time low. Same with the housing market. I started investing in real estate around the 2011 time when markets were at an all-time low. Very lucky, but I got to see the bottom and I started to see it go up and I started to see how emotions changed. And then I saw what happened in 2020 when markets crashed. And I made videos talking about how this is one of the greatest buying opportunities because I don't know what's going to happen tomorrow. Either we're all going to die or markets are going to go back up eventually. And so I made videos talking about how I was buying in phases on the way down. I didn't know what was going to happen next. And I was getting floods of comments. And I don't mean one or two, I mean a flood of comments of people saying, Jaspreet, the market is going to collapse. Why would you buy now? Why would you buy now? You should not be buying now. Wait for markets to implode. Now, I've been studying financial history for a long time. I run a financial technology and financial media company. I'm involved in this space a lot, and I did not expect the Federal Reserve Bank to open up the money printer the way that they did in 2020 and stimulate the stock market the way that they did. But it became very clear that after the pandemic, our economy shifted way more towards an investor-focused economy. It was already an investor-focused economy. Our economic system is designed to make the investor rich, not the employee. That has already been an established fact. But after 2020, it became incredibly more true. So come 2020 now, investors started to become much wealthier, inflation happened, wages didn't keep up. Then came 2022, markets fell by around 20%. Same thing. I made videos talking about how when markets go down, it's a great time to buy. Same thing again. We're just starting to see the beginning. Markets are going to go down even further. We're going to see more downturn in the economy. Well, come 2023, markets not only recovered, we started to break new record highs. Now, I'm not saying that next time we see a downturn, it's going to recover in a day or a week or a month or a year. But what I'm saying is we're going to see another downturn. When? I have no idea. Nobody knows when. But I can tell you that when the next downturn happens, some people are going to get very rich. A lot of people are going to lose money. Which side do you want to be on? Alternatively, during the times that we're not in a downturn, investors are going to get richer. Period. While the average person falls behind. Period. And this is where people try to get into the game of trying to time the market, that I want to time the market and buy when markets are down, and then I'm going to sell when markets are high. But what ends up happening to that person is when markets do go down, they play that waiting game. I can't wait till markets go down a little bit further. I want markets to go down a little bit more before I start buying. Oh, we're so close. It's just going to go down a little bit more and the markets start to go up a little bit. And then you say, I wanted to buy, but it's a little bit too high right now. Let me wait. And then next thing you know, not only the markets recover, they are breaking new record highs. So you miss that opportunity. And it's the same thing on the other side. People say, when Bitcoin hits $110,000 a coin, I'm going to sell. Hypothetically, I'm not saying you should sell. I'm just saying this is what some people do. They create these sell parameters for their investments. And then Bitcoin hits $100,000, $110,000, and then it goes to $112,000. And they say, you know what, how about we just make it $115,000 my goal. Then it goes to 115, then it goes to 120, and you say, okay, I'm going to sell it at 120, but then it goes to 121. And you say, you know what, I'm going to sell it at $130,000. Well, next thing you know, Bitcoin goes down to $80,000, and you say, oh shoot, I shouldn't have kept it, I should have sold it. And so now we get into this game of trading as opposed to building actual investing frameworks. So you have to remember now, what is your goal as an investor? Number one, you need to be investing for the long term. Number two, don't invest money that you are not willing to lose. Number three, don't invest in things that you don't understand. And then you have to start thinking like an investor and understand there is this duality. Number one, it's investing makes sense when you have time to invest, because we know markets go up and down. And you want to be able to have time in the markets to be able to go up. But on the flip side, when markets go down, You don't want to ignore the opportunity there, because when markets go down, you want to have the money to be able to go out and actually invest when markets are down. And this is where you got to have kind of a two framework system. That way you can invest when markets are going up and have some extra money for when markets go down. Because when markets go down, not if, but when, you want to be able to come in and buy. And I can already tell you what's going to happen. At some point, I don't know when, but at some point markets are going to crash. And then there's going to be two types of people. One people is, Jaspreet, I'm losing everything. What do I do? Oh my God, I need to sell. I'm going to sell out. I'm losing money. And then there's the other people that are going to say, should I buy? This is a great time to buy good investments at a discounted price. Which side do you want to be on? When markets go down, you want to be the person that's buying. Now, when markets are going up, you're also going to see two types of people. When markets are going up, you're going to see some people that are saying, wow, I'm going to keep buying because I believe in the long-term value. Key long-term value, because you want to be able to go beyond just the market downturns. And then you're going to see the people that are going to sit on the sidelines saying, I wish I bought, I wish I bought, I wish I bought, keeps going higher, I wish I bought, I wish I bought. I'm going to buy when markets crash, and then when markets crash, I'm going to buy when it's lower, I'm going to buy when it's lower, I'm going to buy when it's lower, and then you never invest. If you are the worst investor in the world and you bought at every peak, you bought during the 2022 peak right before markets fell by 20%. You bought at the 2020 peak right before markets fell by around 35%. You bought at the 2008 peak right before markets got crushed during the great financial crisis. And then you bought during the 2000 dot-com bubble peak. Well, if you bought at every single one of those peaks, but you didn't sell, you would still be richer today versus the person that didn't buy. Now, hopefully you're not the worst investor in the world, but you get the idea. See, we start to get very emotional with our investments, but if you're going to invest in 2026, understand there's going to be even more emotion in 2026 than before. How do I know that? Because we're going to see a lot of changes. We are seeing changes in the Federal Reserve Bank. We are seeing changes with money printing. We're seeing changes with economic policy. We're seeing changes with government policy, and we're seeing changes in our economy. AI is shifting our entire economy faster than the internet, faster than social media, faster than blockchain. Some people get it, a lot of people don't. And all of these things now coming together are going to create emotion, they're going to create volatility. It's also going to create opportunity. And that's what you need to understand. Markets go up, markets go down, but your job is not to predict when markets go up and down, it's to be ready for when markets go up and to be ready for when markets go down, because we know that both things happen and they're going to continue happening. This is why, again, January 13th, I have my investor workshop. I have the link for you down in the description, but on this workshop, I'm going to be going over how money is shifting and how they create investment opportunities now in 2026. That way you can find better opportunities. But again, you got to be a long-term investor, not a trader. Investing means investing for the long term, not investing money that you can't afford to lose, and not investing in things that you don't understand. And when you understand those things, now you can start to be a lot calmer through the sea of noise, through the sea of emotion that happens, because unfortunately, there's a lot of money in trying to sell you emotion. And hopefully now you understand the fundamentals to be an investor, because one more thing that I want you to understand. Things are generally not as good as the media makes them seem. Things are generally never as bad as the media makes it seem as well. And when you understand that, you can start to sift through the noise and find the real investment opportunity instead of chasing the emotion. Hope you got value out of this video. I will see you on YouTube very soon.